Welcome to the deep dive. Today we're digging into private equity, or PE. It's this world of, well, huge deals, potentially massive returns, but what is it, really? How does it work? And maybe most importantly, what's the real story on its performance and its impact?
Exactly. We've sifted through, I think it's over 80 academic studies to try and give you the essentials.
So if you want to get up to speed on private equity without wading through stacks of research yourself, you're definitely in the right place.
Consider this your shortcut. We're aiming to pull out the key insights, make sense of this, frankly, enormous part of the financial world.
And our main guide for this is a really comprehensive review by Alexander Ljungqvist. It's called The Economics of Private Equity, a critical review, published by the CFA Institute Research Foundation.
So think of our mission today as extracting the most important nuggets about PE. Where it came from, its key features, how performance is measured, those big claims about creating value, and what it all means if you're an investor.
Okay, sounds good. So let's start right at the beginning. In simple terms, what exactly is private equity?
Well, at its core, you've got these specialized investment funds. They buy companies, sometimes public ones, they take private, sometimes already private ones.
Right.
And the goal is to actively improve these businesses over, say, several years, and then sell them for a profit. That's how they generate returns for the people who invested in the fund.
Okay, so actively improving them. Now, how is this different from, say, venture capital or private debt? You hear those terms thrown around too.
Good question. It's important to distinguish. Private equity, as we're discussing it, usually focuses on more mature, established companies. We're not typically talking about funding brand new startups. That's more the realm of venture capital, which, Darin and others have studied extensively.
Yeah.
And it's also different from private debt, which is basically just lending money to companies. That's a whole other area. Folks like Block have looked into that deeply. PE is about ownership and control, usually.
So buying established businesses, taking control, trying to make them better, less about finding the next Google in a garage, more about reshaping existing players. How did this industry even start? Where did it come from?
Well, the modern form really took off in the 1980s. That was the era of the LBO, the leveraged buyout.
Ah, yes, the famous LBOs.
Right, firms would acquire often very large, well-known companies. RJR Nabisco is the classic example everyone remembers. And they did it using a lot of borrowed money.
Leverage, hence the name.
Exactly. And this was often financed by those high-yield bonds, junk bonds, as they commonly called a market, really pioneered by Michael Milken and his firm, Drexel Burnham Lambert. Those deals were huge, sometimes hostile, very high profile.
The whole barbarians at the gate, greed is good, perception people have of the 80s. But that initial boom didn't last forever, did it?
No, it didn't. Towards the end of the 80s, you had rising interest rates, slowing economy, and a lot of those highly leveraged companies started to struggle.
Too much debt.
Precisely. The market sort of peaked, then declined around 1990. That's also when Drexel ran into legal trouble and eventually went bankrupt.
So a bit of a classic boom and bust cycle. Where did PE go after that? Did it just disappear?
Not at all. The 90s actually saw a rebound, and the industry became much more institutionalized. The focus shifted somewhat, maybe less purely financial engineering, more towards genuinely improving the operations of the companies they bought.
Okay.
Fund sizes grew. You started seeing these massive mega funds emerge. Then, of course, the dot-com bust in the early 2000s hit some firms.
Right.
But then from about 2003 to 2007, there was another huge boom. Lower interest rates helped fuel that. That period saw some enormous club deals where multiple PE firms banded together to buy really big companies like the TXU Energy deal.
I remember that one. Didn't that run into problems later, too?
It did, yes.
Yeah.
TXU eventually filed for bankruptcy in 2014, so it definitely shows the risks involved, even in those boom times.
It's quite a history, full of cycles. So, fast forward to today. How big is private equity now? Is it still sort of a niche corner of finance?
Oh, far from niche. It's enormous, a major, major asset class. As of 2022, McKinsey estimated the total global assets under management in PE reached something like $3.3 trillion.
Wow, $3.3 trillion. That's hard to even picture. Who's actually putting all this money into PE funds?
It's primarily large institutional investors. They Pension funds, insurance companies, university endowments, foundations. A survey back in 2017 found 88% of foundations and endowments invest in PE.
Okay.
You see big names like the Yale Endowment with, I think, around 17.5% allocated to PE, or the Virginia Retirement System, even higher, maybe 33%. These are investors with very long time horizons looking for potentially higher returns than they can get elsewhere.
So it's not really individuals like you and me buying these companies directly. It's these big pools of capital working through intermediaries. Yeah.
Exactly right. Private equity is an intermediated market. The asset owners, the endowments, the pensions, they commit capital to a PE fund. That fund is run by a specialized PE firm, the manager.
Right.
And they're the ones who find the companies, buy them, work with them, and eventually sell them. The success of the whole thing really hinges on the skill of those fund managers. They're called general partners, or GPs.
GPs, okay.
They need to be good at picking the right companies, implementing growth strategies, managing the debt, and finding a good exit. And crucially, there needs to be alignment between their interests and the interests of the investors, who are called limited partners, or LPs.
GPs and LPs, got it. Okay, so let's dig into that structure a bit more. How are these PE funds actually set up? What are the key institutional features we need to know?
Well, the standard structure is a limited partnership. You have the general partner, the GP, that's the PE firm managing the fund, making the decisions.
Right, the managers.
And then you have the limited partners, the LPs. They provide, the vast majority of the capital. Those are the institutions we just talked about, sometimes very wealthy individuals too.
Okay.
And the whole relationship, all the rules, fees, terms, it's all governed by a very detailed legal document called the Limited Partnership Agreement, or LPA.
The LPA sounds important.
It is. It lays out everything, including protective clauses called covenants that kind of restrict what the GP can and can't do with the LP's money.
And what about the timing? Do these funds just go on forever?
No, they have a defined life, typically around 10 to 12 years, maybe a bit longer sometimes with extensions.
Okay.
It usually starts with what's called a commitment period, maybe 3 to 5 years. During that time, the GP is actively sourcing deals, buying new companies, and starting to work on them.
Making investments.
Right. After that period ends, they generally stop buying new platform companies, though they might still do smaller add-on acquisitions for the businesses they already own using capital they've set aside. Then there's an active period where they're focused on improving the companies and eventually selling them, the harvesting phase. And finally, the fund winds down, distributing the last proceeds.
So because they have this finite life, the PE firms themselves need to keep raising new funds.
Exactly. To stay in business, a PE firm has to go back to investors every, say, 3 to 5 years to raise their next fund. So a big firm might be managing multiple funds all at different stages simultaneously.
Right.
And it's worth noting, too, that PE firms often manage other pools of capital, like side vehicles, for specific deals alongside their main flagship funds. It gets quite complex.
It sounds like it. How does the oversight work compared to, say, a public company with a board of directors and shareholder meetings?
It's generally less formal. LPs rely heavily on that LPA document we mentioned. They can take legal action if the GP breaches the agreement.
Okay.
There's also usually something called a Limited Partner Advisory Committee, or LPAC. It's typically made up of representatives from some of the larger LPs.
And what does the LPAC do?
They mainly weigh in on potential conflicts of interest or approve significant changes to the fund's terms if needed. But they don't get involved in the day-to-day investment decisions or managing the companies. That's the GP's job.
Okay. Now, how does the money actually flow? I've heard about capital calls. What's that process?
Right. So when an LP commits, say, $100 million to a fund, they don't just wire that $100 million on day one.
Ah, okay.
Instead, the GP calls the capital as they need it to fund specific investments or pay fees. They'll issue a capital call notice, usually giving the LPs a certain number of days, specified in the LPA, to send in their portion of the money.
And what happens if an LP can't send the money when called?
That can be serious.
Yeah.
Defaulting on a capital call can lead to penalties, potentially even forfeiting your entire stake in the fund.
Wow.
But in practice, GPs often try to work with LPs facing temporary issues, maybe help them find someone else to buy their remaining commitment. They want to maintain good relationships for future fundraising.
Makes sense. This structure also means LPs don't really control the timing of when their money gets put to work, right?
Exactly. They commit the capital, but the GP decides when to call it. It can take several years for an LP's full commitment to actually be invested.
Okay. Now, you mentioned leverage earlier, debt. How big a role does that play?
A very big role, typically, especially in traditional buyouts. Unlike VC, PE deals usually involve borrowing a significant amount of money alongside the equity the fund puts in.
How much debt are we talking about?
Well, the ratios vary, but for example, PitchBook data suggested that in 2022, the average leverage in U.S. PE deals was around 5.9 times the company's earnings. That's quite substantial.
5.9 times earnings.
Yeah, that's a lot. Where does this debt come from?
Initially, it's often arranged by banks, but then it's frequently syndicated, meaning sold off in pieces to other institutional investors like loan funds or CLOs.
Okay, so the PE fund puts in some equity, borrows a lot more, and buys the company. Is all the equity cash up front? I think you mentioned something about other financing techniques. Right. There's another layer here that's become very common. Equity bridge facilities, or subscription line facilities.
Subscription lines, what are those?
Essentially, the fund takes out a short-term loan from a bank, secured against the LP's unfunded commitments. The GP uses this loan money to make the initial investment or pay fees.
Okay.
Then, later, sometimes months later, the GP issues the capital call to the LPs. The money from the LPs is then used to pay back that short-term subscription line loan.
Why do they do that? Why not just call the capital immediately?
Well, a key effect is that it delays the point at which the LP's capital is officially in the deal. And this delay can artificially inflate the fund's reported internal rate of return, the IRR.
How does it inflate the IRR?
Because IRR is very sensitive to the timing of cash flows. By shortening the time the LP's capital is actually deployed according to the calculation, even if the eventual profit is the same, the annualized return figure looks higher.
Ah, I see. It makes the clock start later for the LP money.
Precisely. Especially in the early years of a fund. Research by Albertus and Deans estimated that using these subscription lines boosts reported IRRs by an average of about 1.9 percentage points.
Wow. So those early reported IRRs might look great, but part of that could just be this financing technique.
It's definitely something LPs need to be aware of when looking at performance figures, especially interim ones. It doesn't necessarily mean the underlying investments are doing better, just that the timing of the capital calls has been managed.
That's fascinating. Okay, so let's pivot to that big question. Performance. How is private equity actually done for investors? It feels like you hear wildly different stories.
Yeah, it's a really central question, isn't it?
Yeah.
But answering it simply like, is PE performance good or bad? It's surprisingly tricky.
Why is it so difficult?
Two main reasons. First, these are illiquid assets. You can't just look up the price on a screen every day like a public stock. Valuing private companies involves estimation.
Right.
Second, the investment horizon is very long. PE funds operate over 10, 12 years, sometimes more. The real payoff, if it comes, is often back-end loaded. Think of the classic J-curve pattern.
Ah, the J-curve. Explain that again quickly.
Sure, it's that typical shape you see with PE fund cash flows. Initially, it dips below zero as the fund calls capital from LPs to make investments and pay fees. Then, hopefully over time, as portfolio companies start generating cash or get sold, the curve rises into positive territory. But those positive returns often don't materialize significantly for several years.
Okay, that initial pain before the potential gain later on. So given these challenges, how does the PE industry itself measure and report performance back to its LPs?
They primarily rely on three main key performance indicators, or KPIs: IRR, TVPI, and DPI.
Okay, IRR, we just touched on internal rate of return. Tell us more about that one in this context.
Right. IRR was that annualized rate of return that factors in both the size and the timing of all the cash flows, money going from LPs to the fund and money coming back from the fund to LPs.
And you said it can be tricky to calculate.
Especially during the life of the fund. The truly final, accurate IRR can only be calculated once every single investment is sold and all cash is returned.
But they report it before then.
Yes, the industry standard is to report an interim IRR throughout the fund's life. To do that, they have to estimate the current value of all the companies still held in the portfolio, the unrealized holdings, and basically treat that estimated value as if it were a final cash distribution.
And valuing those private, unsold companies must be subjective, right? There's no perfect market price.
Exactly. It involves judgment calls, valuation models, maybe comparisons to public companies. So those interim IRRs are really just estimates, educated guesses about what the final outcome might be.
And potentially open to being managed.
There are definitely concerns, particularly around fundraising time, that GPs might be incentivized to use more optimistic assumptions to boost that reported interim IRR. And as we discussed, things like subscription lines can also influence the number.
Okay, so IRR is one metric, but it has its caveats. What are TVPI and DPI?
TVPI stands for total value to paid-in capital. It's a multiple. You take the total cash distributions received by LPs so far, add the current estimated value of the remaining investments, and divide all that by the total capital LPs have contributed.
So a TVPI of 1.5 means for every dollar paid in, the total value generated, cash back plus remaining value, is $1.50.
Correct. A TVPI greater than 1 means, on paper at least, the fund has created value beyond the initial investment. But like IRR, it relies on those estimated unrealized values. And crucially, TVPI ignores the time value of money. A TVPI of 2 achieved over 3 years is very different from a TVPI of 2 achieved over 12 years.
Right. Time matters. What about DPI?
DPI is distributed to paid-in capital. This one is simpler and based purely on realized results. It's just the total cash distributed back to LPs divided by the total capital they paid in.
So no estimated values in DPI?
None. It only measures the actual cash returned. So a DPI of 1 means the LPs have gotten their initial investment back in cash. As the fund matures and sells assets, the DPI should gradually increase along that J-curve. But like TVPI, it doesn't tell you how long it took to get that cash back.
Okay, so IRR, TVPI, DPI, they all give different pieces of the puzzle, but they are absolute performance measures, right? They don't tell you how you did compared to, say, just putting the money in the stock market.
Exactly. They don't adjust for market conditions or risk. LPs do often compare these metrics against other PE funds from the same vintage year. Being in the top quartile is usually seen as a good sign. But that's comparing PE to PE.
So how do we compare PE performance to the public markets, like the S&P 500? That seems like a crucial benchmark.
That's where the public market equivalent, or PME, comes in. It's a really important concept developed specifically for this purpose.
PME, public market equivalent. How does that work?
The basic idea, developed by researchers like Ljungqvist and Richardson and Kaplan and Shore, using a slightly different but related method, is to simulate what would have happened if you'd invested the same amounts of money at the same times into a public market index instead of the PE fund.
So you track the PE fund's cash flows, the calls and distributions, and compare the outcome to investing those same flows in, say, the S&P 500.
Precisely. You calculate what the end value of those equivalent public market investments would be and compare it to the end value generated by the PE fund. A PME greater than 1 suggests the PE fund outperformed the public market index over that period after accounting for the timing of cash flows.
And does PME have advantages over just comparing IRRs?
Yes, it has some desirable properties. You don't need detailed risk data for every private company in the fund. And importantly, researchers like Sorensen and Jagannathan show that PME is generally invariant to the use of leverage within the fund and the specific timing of investments, which helps provide a more apples-to-apples comparison.
Okay, so PME sounds like a pretty robust way to benchmark against public markets. What do the academic studies using PME find? Has PE historically outperformed the S&P 500 after fees?
Broadly speaking, yes. The general consensus from numerous studies using reliable data sources and PME analysis is that, on average, private equity funds historically have delivered net of fee returns exceeding those of public equity benchmarks like the S&P 500.
So higher returns even after the GPs take their cut.
That's what the bulk of the evidence suggests. There are some older studies using data sources now considered less reliable, like the old Venture Economics database, that showed underperformance. But the more recent, widely cited research using better data generally points towards historical outperformance on an absolute basis.
That sounds pretty good for PE investors then. But wait, what about risk? Are those higher returns just compensation for taking on significantly more risk than investing in the S&P 500?
Now you've hit the really big contentious debate. Adjusting for risk is where things get much, much murkier.
Why is it so hard to figure out the risk-adjusted returns?
Because measuring the risk of private, illiquid investments is inherently difficult, and different researchers use different models and assumptions to try and account for it.
So, what do the studies find when they try to adjust for risk?
Well, the results are all over the map, frankly. For example, one study by Dressen and colleagues, using a standard risk model called a CAPM, found basically no evidence of outperformance once they adjusted for market risk.
So higher returns, but just because it was riskier?
According to that study, yes. But then another study by Eadsons and others used a different model, the Fama-French three-factor model, which considers exposure to small companies and value stocks. They did find positive risk-adjusted returns, or alpha.
Why the difference?
Their argument was that PE funds tend to invest more in smaller companies and value-type situations, which historically have higher returns anyway. And the three-factor model captures that better than the basic CAPM.
Okay, so maybe some alpha, but is that the final word?
Not even close. More recent work by Gupta and Van Nieuwenburg, using yet another approach looking at expected returns and a wider range of risk factors, actually concluded that PE funds generated negative abnormal returns after fees once risk was properly accounted for.
Negative returns, so underperforming after risk adjustment.
That's what their analysis suggested. And adding another perspective, a study by Boyer and colleagues looked at prices in the secondary market where LP stakes are traded, and they also found no clear evidence of risk-adjusted outperformance.
Wow, so depending on which study you read and which risk model they use, you get completely different answers about whether PE delivers true alpha.
That's pretty much the situation.
Yeah.
There's no firm consensus in the academic literature on whether PE consistently generates positive risk-adjusted returns after fees. The choice of data set, the methodology for risk adjustment, it all leads to different conclusions.
What about the leverage factor? PE deals use way more debt than the average public company. Doesn't that automatically mean higher risk?
It certainly contributes to the risk profile. Now, as we mentioned, the PME calculation itself is designed to be neutral to leverage. But some researchers have tried to tackle this directly.
How?
L. Herr and colleagues, for instance, created a benchmark index of public companies adjusted for size, sector, and leverage, similar to PE deals. Comparing PE returns to that benchmark, they found zero alpha.
Okay.
And another study by Stafford concluded that PE actually underperformed a simple strategy of just buying publicly traded small-cap value stocks and applying leverage to them.
So maybe you could replicate PE returns just with leveraged public stocks.
Well, that's the implication of Stafford's study. But then again, other researchers like Ang and his co-authors argue the opposite, that PE returns cannot be replicated simply by leveraging listed stocks, suggesting there's something unique about PE. So the debate continues.
It sounds incredibly complex. What about liquidity? PE is famously illiquid. You lock your money up for years. Could the higher returns just be compensation for that lack of liquidity?
That's another very important part of the puzzle, the idea of a liquidity premium. There are a few angles to this.
Like what?
One is exposure to overall market liquidity, the risks that it becomes hard to trade any asset. Franzoni and others found that once you account for PE funds' sensitivity to these market-wide liquidity fluctuations, their apparent alpha disappears.
So maybe PE investors are just getting paid for bearing market liquidity risk.
That's what their study suggests. Ang's research also points to PE returns being related to illiquidity factors.
Okay, what else?
There's the simple fact that LPs can't easily sell their fund stakes if they need the cash back early. Sorensen and his colleagues argued that the higher average returns observed in PE might simply be the premium LPs' demand for accepting this lockup.
Compensation for tying up capital for a decade or more.
Exactly. And the third angle is the risk of getting those capital calls during bad times when the LP might be facing their own liquidity crunch. Though Robinson and Sensoy argue this probably isn't a major driver of average returns across the board.
So it really seems like a big chunk, maybe even all, of PE's historical outperformance compared to public markets might be explained by various forms of market risk, leverage risk, illiquidity risk.
That's certainly a very plausible interpretation of the evidence. While PE might offer diversification benefits, achieving truly superior risk-adjusted returns seems much less certain than the headline absolute return figures might suggest.
Okay, let's shift slightly. What about manager skill? We often hear that picking the right PE manager is crucial. Is there evidence that some managers are consistently better than others? This idea of return persistence.
Yes, that's been a major focus of research. Early, very influential work by Kaplan and Shore did find evidence of persistence, particularly in the 80s and 90s.
Meaning that top-performing funds tended to be followed by other top-performing funds from the same firm.
Exactly, which suggests that some GPs might possess genuine skill that persists over time, rather than just getting lucky on one fund.
Has that finding held up in later studies?
Generally, yes. Several other studies, including by Robinson and Sensoy, Korteweg and Sorensen, and Gupta and Van Nieuwenburg, also found persistence. However, some more recent work, like by Harris and colleagues, suggests this persistence might have weakened somewhat in recent decades.
Weakened? Why might that be?
Potentially due to increased competition in the industry, maybe more capital chasing deals, making it harder for even skilled managers to consistently outperform by a large margin.
But is there still a big difference between the best and worst managers?
Oh, absolutely. The dispersion of returns between the top quartile and bottom quartile PE funds is still significantly wider than what you see in, say, mutual funds. Cordwag and Sorensen estimated that gap could be 7 or 8 percentage points per year.
That's a huge difference. So manager selection really does matter enormously for LPs.
Critically important.
Yeah.
But there's a practical challenge.
What's that?
Most studies measure persistence based on the final realized returns of a fund over its entire 10, 12-year life. But GPs are out raising their next fund every 3 to 5 years, long before those final numbers are known.
Oh, right. So LPs have to make decisions based on incomplete interim data.
Precisely. They have to rely on those interim IRRs, TVPIs, and DPIs we talked about, which are much noisier signals and less predictive of long-term future performance. It makes picking the next winner based purely on past reported numbers very difficult.
So even if persistence exists historically, it's hard for LPs to actually exploit it reliably.
It's challenging. Interestingly, research by Hochberg and her co-authors suggests that existing LPs in a fund might have an edge. They might have better soft information about the GP's team, strategy, and deal flow, which gives them more bargaining power, perhaps allowing them to negotiate better terms on future funds, rather than just relying on those potentially misleading interim KPIs.
Fascinating. So relationships and deeper due diligence matter more than just looking at the reported numbers. Okay, what about broader market factors? Do things like how much money is flowing into PE overall, or how cheap debt is, affect returns?
Yes, definitely. There's evidence for both. Gompers and Lerner found that periods with large capital inflows into PE tend to be followed by lower returns, likely because all that money chases deals and pushes up purchase prices.
Too much money chasing too few deals.
Kinda, yeah. And similarly, Axelson and colleagues found that funds raised during periods when debt financing was cheap and easily available also tended to have lower subsequent returns.
Why would cheap debt lead to lower returns? Wouldn't it help boost returns through leverage?
It boosts the potential upside, but the argument is that easy credit leads PE firms to overpay for companies at the entry point. Higher entry multiples make it harder to generate strong returns later on, even with leverage. Though again, there's some nuance. Robinson and Sensoy found less impact from capital flows when looking at relative performance rather than absolute.
Okay, so the overall economic environment clearly plays a role alongside manager skill. Let's move to another huge topic, value creation. Does PE actually make companies better, or is it mostly about financial engineering and shifting wealth around?
This is probably one of the most debated aspects of private equity. The industry itself heavily promotes the narrative that they create value through operational improvements, driving growth, improving efficiency, and so on. They often point to job growth numbers in their portfolio companies.
But critics sometimes paint a very different picture, right? Asset stripping, loading companies with debt, layoffs. The locusts comment from Germany comes to mind.
Exactly. You have these two opposing narratives. Interestingly, when researchers actually surveyed GPs themselves, asking what drives returns in their deals, the GPs ranked things like growth in the value of the underlying business and operational improvements as the most important factors, more important than just leverage or market timing.
That's what they claim. But what does the independent academic evidence show?
Well,
Do companies actually change operationally after being bought by PE?
there's quite a bit of research on this now. Several studies across different countries, Europe, the US, France, generally find that PE-owned companies tend to grow their sales faster than comparable non-PE-owned companies. The evidence on profitability growth is a bit more mixed, but often positive too.
What about productivity? Did they become more efficient?
Early research in the U.S. manufacturing sector back in the 80s by Lichtenberg and Siegel did find increases in total factor productivity under PE ownership, though it often came with cuts to white-collar jobs.
Okay.
More recent work by Steve Davis and colleagues, using very detailed data on individual business establishments, confirms these productivity gains. Their work suggests PE often drives a reallocation process, shutting down less productive plants or units, expanding more productive ones, opening new ones.
That sounds like it could involve significant job turn, even if overall employment doesn't change much.
Yes, their research points to high rates of gross job creation and destruction within PE-owned firms, even if the net effect on total employment is often found to be relatively small, or sometimes slightly negative, sometimes slightly positive, depending on the study and context.
So the impact on jobs isn't straightforwardly positive or negative?
It seems very context-dependent. For instance, the same researchers found that buyouts of public companies tended to lead to net job losses, while buyouts of private companies often led to net job gains. Studies in different countries like Sweden and Germany have found nuanced effects, sometimes impacting certain types of workers, like older workers or those in routine jobs, more than others. Wage impacts also seem mixed. Some studies find little change in average wages, others find reductions, particularly for managers. One study even found lower reported job satisfaction despite stable wages.
What about investment in the future, like innovation or R&D?
The evidence there is somewhat positive too. That early Lichtenberg and Siegel study found increased R&D intensity. Lerner and co-authors found that PE-backed firms produced patents that were more highly cited, suggesting higher quality innovation.
Oh.
And research in the UK also found increased patenting activity.
Okay, so there is evidence of real operational changes, faster sales growth, productivity gains, maybe more innovation. But the crucial question remains, are these changes caused by the PE firm's involvement, or are PE firms just really good at picking companies that were already improving or about to improve anyway?
That's the million-dollar question. The selection versus treatment effect. It's incredibly hard to definitively prove causality.
How do researchers try to tackle that?
The standard approach is to carefully match PE-owned companies to similar non-PE-owned control companies based on characteristics before the buyout, and then track how their performance evolves differently after the buyout.
So, comparing trajectories.
Exactly. Any divergence in performance after the deal is attributed, at least partially, to the PE treatment. But it's never a perfect comparison. You can't completely rule out that the PE firm saw something unique that wasn't captured in the matching variables.
But is there evidence linking those operational improvements back to the financial returns for the LPs?
Yes. Acharya and colleagues, for instance, did find that the portfolio companies exhibiting stronger improvements in sales and profitability contributed significantly more to the overall financial returns of the PE fund. So it suggests these operational changes aren't just happening in isolation. They do seem to drive value for investors.
Okay, so it's probably not just financial engineering. But what about the impact beyond the company and its investors? Does PE create broader social value, or does it sometimes harm other stakeholders?
This is where it gets really complicated, looking at externalities, the spillover effects. There could be both positive and negative ones.
What are some potential positives?
Well, some argue PE makes industries more competitive overall. Research by Bernstein and others found that industries with more PE activity saw faster growth in sales and employment, among non-PE firms too, suggesting positive spillovers.
Interesting. What about consumers?
One study looking at consumer goods found PE buyouts led to only marginal price increases, but higher sales driven by increased quantity and greater product variety, potentially a plus for consumers.
Any other positives?
There's some evidence of improved workplace safety, fewer OSHA violations, lower injury rates in some studies, and improved health inspection scores in PE-acquired restaurant chains.
Okay, those sound good. But we know there are major concerns in specific sectors, right? Like healthcare.
Absolutely. Healthcare is probably the most contentious area right now. The research findings are really mixed and often debated.
How so?
Some studies suggest PE ownership improves hospital efficiency without harming quality. But others find PE-owned physician practices or hospitals lead to significantly higher costs for patients and insurers due to aggressive price negotiation.
And what about quality of care?
That's where the biggest concerns lie. A widely discussed, though still peer-reviewed, study by Gupta and others reported higher patient mortality rates in PE-owned nursing homes. Other research suggests harm might be concentrated in less competitive healthcare markets. It's an area needing much more research, but the potential for negative impacts is clearly there.
What about other sectors? Education, media?
Yes, concerns there too. Research on PE acquiring for-profit colleges linked it to rising tuition and student debt, alongside falling graduation rates and subsequent earnings for students.
Ouch.
In local newspapers, studies found PE ownership led to a shift away from local news coverage towards more national content, fewer reporters, and even potentially lower voter turnout, despite investments in digital platforms.
And the environment.
The evidence there is also nuanced. Some studies find PE firms don't pollute more than comparable public firms. Others find they might reduce toxic emissions in industries like fracking if liability risks are high. And some find PE-owned power plants operate more efficiently. It's not a simple good or bad story.
So it really sounds like PE creates winners and losers, and whether it generates net social value is incredibly hard to determine, and likely varies a lot by industry and specific practices.
That's a fair summary. The potential for negative externalities is real, And that's often the justification for thinking about regulation or government intervention to try and align the incentives better between PE firms generating private returns and achieving broader societal well-being.
Okay, a very complex picture indeed. Let's switch focus now to the investors themselves, the LPs. If you're an endowment or a pension fund deciding to invest in PE, what are the key things you need to consider?
Well, as we discussed, manager selection, picking the right GP, is absolutely paramount.
But didn't you say relying on past performance persistence is tricky?
It is. While historical persistence exists to some degree, it's not a perfect predictor, especially using interim data. So LPs really need to conduct deep qualitative due diligence.
What does that involve?
Looking beyond the numbers. Understanding the GP's investment strategy, how they source deals, the quality and stability of their team, the resources they have, their track record on operational improvements, reference checks. It's a lot of work.
And does being bigger help? Do large LPs do better?
There's evidence they do. Dick and Peworski found larger LPs tend to earn higher returns, potentially because they can afford to invest more in building the internal teams and expertise needed for that intensive due diligence and manager selection process. Scale matters in being a sophisticated PE investor.
What about the size of the PE fund itself? Is bigger better there?
Not necessarily. There's research suggesting potential diseconomies of scale. Lopez de Solanas and others found that when PE firms get really big and are juggling too many deals, the performance of individual deals can suffer.
Am I too stretched?
Potentially. The idea is that the hands-on operational engineering that PE claims to do becomes harder to execute effectively across a massive portfolio. So a key due diligence question for LPs is, can this GP effectively scale up? Do they have the team and processes to manage a much larger fund without performance slipping?
Even though some studies don't find a strong negative link between fund size and performance overall.
Right, the cross-sectional evidence is a bit mixed, but the question of whether a specific GP raising a much larger fund than their previous one might underperform is still a valid concern for LPs.
Okay. We also touched on conflicts of interest between GPs and LPs, the principal agent problem. How else does this show up?
It's inherent in the structure, really. GPs are investing other people's money, OPM, and the LPA, however detailed, can't foresee every situation. The compensation structure itself creates potential misalignment.
The 2 and 20 model.
Yes, the 2% management fee provides steady income, but the 20% carried interest in the profits creates a very convex payoff for the GP. Huge upside if things go well, but limited downside personally if they don't.
So an incentive to take more risks than LPs might want.
Potentially, yes. Especially since good performance allows them to raise bigger future funds, generating more management fees. This risk-taking incentive can be amplified when debt is cheap and plentiful. And some research even shows first-time GPs take more risk to try and establish that initial track record.
You also mentioned potential gaming around fundraising time.
Right. The incentive to make the current fund look as good as possible when you're asking LPs for money for the next fund is strong. Research by Barber and Yasuda found fundraising often coincides with peak reported interim performance, suggesting potential NAV inflation.
Do LPs get fooled by this?
Maybe not entirely. Brown and colleagues found that while struggling GPs might inflate NAVs more, sophisticated LPs seem somewhat able to see through it. But the temptation is there. And using subscription lines to boost interim IRRs, as Albertus and Valle showed, also fits into this potential gaming category. The SEC has certainly expressed concerns about this.
It sounds like LPs need to be incredibly vigilant. Are there ways LPs are trying to get around some of these issues, maybe get closer to the investments?
Yes, we're seeing more disintermediation. Co-investment programs are a big example.
Co-investing, what's that?
It's where LPs invest directly into specific portfolio companies alongside the main PE fund. Often they pay lower or even no fees and carry on that specific co-investment piece.
What's the benefit for the LP?
Lower overall fees, potentially higher net returns if the deals perform well, and more direct exposure to the underlying companies. For the GP, it gives them access to more capital to do larger deals.
But it requires the LP to do their own homework on the specific company deal.
Absolutely. You need the internal resources and expertise to evaluate the co-investment opportunity yourself, so it tends to be more common among the larger, more sophisticated LPs.
How has co-investment performance been?
The early evidence was mixed. One study suggested underperformance, maybe due to GPs offering LPs the less attractive deals, adverse selection. But more recent research found performance generally in line with the main funds.
Are FPs going even further, bypassing GPs altogether sometimes?
Some are, yes. making direct investments originating and managing deals entirely themselves. Early research suggests these direct deals by large LPs might actually outperform traditional PE fund investments, though it requires significant scale and capability.
Interesting. Another area we hear a lot about is the secondary market, LPs selling their fund stakes.
Right. Given how illiquid PE fund stakes are, the secondary market provides an exit route for LPs who need to get out before the fund naturally liquidates. These are usually bespoke transactions between a selling LP and a buying investor, often requiring GP approval.
And this market has grown a lot.
Significantly. Billions of dollars trade hands each year. LPs might sell for many reasons: portfolio rebalancing, needing cash, changing strategy.
You also hear about the denominator effect driving sales.
Yes, that happens when public markets fall sharply. If an LP's stock portfolio value drops, their PE allocation, which is valued less frequently, suddenly becomes a larger percentage of their total assets than they intended. To get back to their target allocation, they might sell some PE stakes on the secondary market.
Okay, that makes sense. Now let's look at the other end exits. How are PE firms actually selling their investments these days?
Well, the traditional routes are still there: selling to a strategic buyer, another company in the industry, or taking the company public via an IPO.
But haven't other types of exits become more common?
Hugely so. Sponsor-to-sponsor deals, or secondary buyouts where one PE firm sells a company to another PE firm, now account for more than half of all PE exits globally.
One PE firm selling to another. Why so common?
Various reasons. Maybe the buying firm thinks they have a different skill set to add value, or they have more capital to pursue a growth strategy. But it raises questions.
Like what?
Like, are there diminishing returns? How much more value can be created after one PE firm has already owned it? Are buying firms sometimes just trying to deploy capital near the end of their investment period? And for diversified LPs, they might just end up owning the same asset indirectly through a different fund, having paid transaction fees in the middle.
And there's an even newer trend, right? GP-led secondaries.
Yes, that's grown incredibly fast. This is where the same PE firm manages both the selling fund and the buying fund. Often they move a specific asset from an older fund into a new, specially created continuation vehicle, usually focused just on that single asset.
The same firm is on both sides of the deal. That sounds like a major conflict of interest.
It definitely raises red flags. How is the price determined fairly when the buyer and seller are the same entity? LPs in the original fund are usually given a choice: cash out at the determined price, or roll their stake into the new continuation fund. But the potential for the GP to set a price that benefits them, perhaps allowing them to crystallize carried interest or reset the fee base, is significant.
Have regulators noticed this?
Yes. The SEC recently introduced rules requiring fairness opinions for these GP-led deals to try and protect LPs, but it's a controversial area.
And what's NAV financing?
That's another recent development: net asset value financing. Essentially, the PE fund borrows money against the value of its existing portfolio companies and uses that borrowed money to make distributions back to LPs rather than selling the assets.
Why do that? Just to return cash sooner?
Potentially, especially if exit markets are difficult.
Yeah.
But whether it truly benefits LPs in the long run, given the cost of the debt, is still an open question.
Wow, lots of financial innovation happening. Okay, one last area, ESG, environmental social governance. How is that fitting into the PE world?
It's become a much bigger focus, definitely. A large majority of LPs now say they integrate ESG factors into their due diligence when selecting PE funds.
Why? Risk management, finding opportunities.
Both. They see ESG risks like environmental liabilities or poor labor practices as potentially harming returns, but also opportunities investing in companies that provide solutions to ESG challenges.
Is ESG reporting standardized in PE yet?
Not really. That's a challenge.
Yeah.
There are many different frameworks and rating systems, making it hard for LPs to compare apples to apples. There are initiatives trying to improve data convergence, but it's still evolving.
Is there evidence that focusing on ESG actually impacts PE performance?
Research here is still quite early. Some studies suggest LP demand is driving more voluntary ESG disclosure by GPs, and this correlates with better ESG outcomes at the company level. There's also evidence that bad ESG incidents can hurt a GP's future fundraising. Some argue ESG focus can create value. But the direct link between ESG integration and overall financial performance of PE funds, that's still largely an open question being researched.
Okay, so we've covered a huge amount of ground. Bringing it all together, What are the absolute key takeaways listeners should have about private equity after this deep dive?
Well, I think first, historically, PE has delivered higher absolute returns than public markets, on average. That seems fairly clear from the PME data. But second, whether those returns represent true risk-adjusted outperformance or alpha is much, much less clear. A significant portion, maybe all, could be compensation for various risks, leverage, illiquidity, market factors.
Yeah. What else?
Third, it's a complex asset class with inherent agency issues. The GP-LP relationship has potential conflicts, and LPs need to be sophisticated and diligent. Manager selection is key, but hard to do perfectly.
And we saw that more sophisticated, larger LPs tend to get better results.
Exactly. Scale and expertise matter. And fourth, PE is not static. It's constantly evolving with new practices like subscription lines, GP-led secondaries, NAV financing, and a growing focus on ESG. Investors need to stay on top of these changes.
It certainly keeps things interesting, so perhaps a final thought to leave our listeners with.
Yeah, maybe think about this. As scrutiny increases on PE's broader societal impact on jobs, consumers, healthcare, the environment, and as its own practices keep evolving so rapidly, what role will regulation and transparency play in its future? How do we ensure better alignment between the financial incentives driving PE and overall economic well-being? And what kinds of new opportunities and also new risks might that create for investors, for the firms themselves, and for the companies they own?
Definitely a lot to ponder there. This has been incredibly insightful. Thanks for walking us through the complex world of private equity.
My pleasure. It was a great discussion.
And thanks to all of you for joining us on the deep dive. We'll be back soon with another exploration.